Here, I want to introduce Christina Staib. She's going to be moderating this next panel, which is titled Financing the Future, parenthetically, of CCS. She's got a great panel with her. Christina is a senior client engagement lead. She's based in Houston for the Institute. She's been with us for nearly a year and a half and brings with her 25 years or so of experience in the environment, economics, and engineering. So Christina, over to you.
Thanks, Jeff. I really appreciate that introduction. So what we've heard today is that CCS deployment needs to scale. But in order for it to scale, significant capital is going to need to be allocated towards investment. But in order to mobilize that capital, investors need an economic business model for CCS. And as Jared mentioned this morning, part of the Institute's role is to help champion that conversation about CCS financing, to connect those people that want to deploy technology and projects and those that want to fund them. So today we've convened this panel to shed light on the challenges and opportunities in finance for bringing CCS to scale, as well as the diversity of funding sources available and their roles in advancing deployment. And so on this panel, we hope to provide perspectives from the public sector, commercial banking, philanthropy, and an energy policy and innovation think tank. So good afternoon, gentlemen. So to get us started, what I'd like each of you to do instead of me introducing you is have each of you introduce yourself and, of course, identify your organization and describe what kind of organization it is. And if you could please give a brief overview of your current role, but then probably more importantly, take a couple of minutes to describe how your organization supports the financing of CCS. For example, the stages at which you provide capital and what type of funding you provide. And if you can, also share a little bit about your minimum financing requirements, and that'll baseline this discussion for us. Jay?
Yeah, happy to start. Hey everyone, my name's Jay Dessy. I'm with Breakthrough Energy. And for those who aren't familiar, Breakthrough Energy is an organization founded by Bill Gates in 2015. Our mission is to advance climate and clean energy technologies that can help support the path to net zero emissions. And so Breakthrough Energy is sort of an umbrella organization that includes a number of different programs and funds. Our most mature effort is Breakthrough Energy Ventures, which is our venture capital team. They have raised two $1 billion funds and have about 90 portfolio companies that have invested in climate technologies and startups ranging all parts of the economy. That started around 2018 when we started making investments in those startups. And since then, we've started to build out new efforts that fill other gaps in the commercialization process for climate technologies. And so I work on an effort we launched last year called Breakthrough Energy Catalyst, which really focuses on how we can help bridge the gap for technologies as they're getting deployed in first-of-a-kind projects. And so we're looking to help provide project financing for these technologies that are coming out of the lab and moving from sort of pilot stage toward pre-commercial demonstrations or first-of-a-kind commercial applications. And as many of you know, capital-intensive technologies like CCS face gaps for accessing that sort of traditional project finance capital in order to get sort of those first-of-a-kind projects built. And so our Catalyst program is really designed to help bridge that. We can provide grants towards projects and can make equity investments in projects as well, all with the idea of sort of reducing financing costs, reducing risk, helping crowd in additional investment, and hopefully leading to successful follow-on projects where traditional infrastructure funds or lenders will become more comfortable with investment in projects. And ultimately, we can build projects 2 through 5 and 5 through 10 and 10 through 100. So in terms of our focus areas, we're focused right now on 4 technologies: direct air capture, clean hydrogen, sustainable aviation fuel, and long-duration energy storage. We don't focus directly on point source carbon capture, but obviously direct air capture and kind of carbon removal is a part of the broader carbon capture ecosystem, and so very much focused on how we can scale DAC solutions. And then obviously, CCUS touches a lot of those other technology areas too, like hydrogen and sustainable aviation fuel, where they're often a component of projects as well. So in terms of kind of my role, I support on everything from origination of new projects all the way through investments. We're just, like I said, relatively new, so getting started in our sort of deal sourcing and project investments. Earlier this year, we launched a process, a request for proposal process, where we're soliciting applications from project developers in the US, in the UK, and in Europe, and are now going through the process of evaluating those projects and determining where we're going to make our first investment opportunities, and hope to do so over the next several months. So that's a little bit on Breakthrough Energy and the Catalyst program, and I'll turn it over to some of my other panelists here.
Thank you.
Thank you, Jay. Khalid, please.
I'm Khalid Abedin. I work with Department of Energy's Loan Program Office. I lead the Carbon Management Group in loan originations and underwriting. Many of you know about the Loan Program Office. We are the financing arm of funding new technology and projects in the that's come along through our program, which is a separate discussions. And we are part of the Department of Energy's funding program. In terms of, in a big picture perspective, we are like a fund, kind of like a small bank, with a loan authority of about $8.5 billion. We provide funding from a project from demo stage to commercializations, first of a kind technology, when there is no private sector funding available. So we are kind of like a bridge to bankability of a technology and a project. We work with the private sector because the private sector are not comfortable in taking risk in commercializations of this technology. So we go like 2 or 3 projects at the beginning, and then once the knowledge transfer happen to the private sector in terms of the risk mitigations, risk underwriting, risk pricing, then we kind of like a step aside and let the private sector take off. For example, about a decade ago, utility scale solar project was not funded by the private sector. They were not comfortable underwriting some of the risk. So we stepped in, we filled that gap. We build 3 or 4 some of these utility scale large solar project. And then when the private sector took off, we step aside so we don't do any more funding related to the solar project that big. In addition to that, we also like to let you know that we are kind of like a held to maturity investors. So unlike the private sector, when the loan is underwritten, sometimes they sell the loan to a third party. In our case, we keep the loan in our book until maturity. So we have a vested interest that the project becomes successful, and there is a path to positive cash flow and return for equity at the end. So that's very important. Without that, we cannot bring other stakeholders together to get the transaction done. In addition to that, we have a deep bench of engineers, environmental people, legal people, and also finance people that we come together. There is no other entity in the private sector have so much of knowledge can come together and put a project to its success. So from a risk perspective, we stay during the construction time. We take the construction risk of a project. We take the operation risk of the project. These are our core strength. In terms of other risk that we have to share with the other stakeholder, which is market risk and some of the credit risk. We do take the counterparty credit risk, but in terms of the market risk, we just don't have the tools to manage that risk ourselves. So we have to rely on the private sector to make the cash flow certainty in a way that private sector does better than us. So those are some of the risk sharing. What kind of risk that we feel comfortable? What are the risks that we have to share with the private sector? And then we bring everyone together, and that's how we get a project done. We want to make sure the project is viable, project has a positive cash flow, and it has a reasonable prospect of repayment. I know that people come to us, hey, do we have a grant? No, we don't provide grant. These are loans. There are other entities within Department of Energy, and they provide grants, related to certain technology. So we direct them to those agencies. In many cases, that happens. But at the end of the day, our loan has to have a reasonable prospective repayment, and that's something that we, as a professional, provide the judgment into our underwriting process. With that, I'm going to pause here, and I'm going to let the other two speak. Thank you.
Thanks, Khalid. Michael.
Yes, hello, Michael Brownlie with Macquarie Group. For those of you who aren't familiar with it, it's a large international financial institution headquartered out of Sydney in Australia, but with a global reach. I myself am based in Houston. And in terms of how we're seeking to support the CCS industry, we have three main lines of business that are working in different ways to support that. We have our traditional advisory group, Macquarie Capital, who has the ability to help structure projects, contracts, arrange tax equity deals. They have done that in the past to support carbon sequestration. And very strong in all things energy transition and infrastructure. Then we have a funds management group, again, very strong in energy and infrastructure, one of the world's biggest developers of renewable energies, looking to expand into carbon capture and storage, so looking for projects to support. And then we have the third part of the bank, which is where I work, which is called Commodities and Global Markets. And what we do in Commodities and Global Markets is we work with our clients to help solve their problems around capital, financing, and some of the risk management stuff Khalid talked about. So just, again, give a little bit more perspective on that, a little Australian company, but one of the largest traders of power and natural gas in the US, and emerging and building a business in the voluntary and compliance carbon markets, where we provide a number of our clients access to those markets, but we also provide equity into projects to generate new carbon offsets. And building on that further, now seeking to finance CCS projects. And that falls within my group, which is actually an upstream finance group, which is the logical place for us to put CCS at the moment, because substantially many of the technical, commercial, operational, and even as you get outside of the US, where we finance a number of projects, the societal impacts are very similar for CCS as they are for upstream. So we have within that team the technical expertise, engineers, geologists, facilities financiers, as well as the commercial people to diligence these projects. And it was out of that upstream team that I sit in that we originated our first investment into CCS. It's actually over in the UK. For those of you who aren't familiar, it's the Acorn project on the northeast coast of Scotland, where we're an early stage investor, project seeking to capture carbon from an existing gas processing plant and sequester it into a depleted field offshore. And we came in very early stage on that. It's an equity investment for us, but as the project has continued to move forwards towards final investment decision and construction, we've followed our money, we've continued to make investments. But as we think forward and where we really deploy dollars at scale, a lot of the challenges for us are the same as Khalid mentioned. We're cash flow lenders at the end of the day. We need to see projects that generate enough cash flow to pay us back. That is essentially the really simple answer. The nuance behind CCS, and we try and talk about CCS as a thing, I mean, CCS is a bolt-on to lots of other industries. And so as we're looking at financing CCS, we're not really just looking at CCS, we're looking at CCS and the industry it's attached to. Some of those are easier inherently to de-risk than others. So maybe the power sector is easier to de-risk in terms of long-term predictability, but how do I de-risk the long-term price of cement? There's a whole bunch of additional nuances that come with CCS that I think we need to be mindful of when we consider just CCS as an industry. It's a service to a lot of other industries.
Thank you, Michael.
Well, I probably don't fit in this because I used to be an investment banker for about 25 years and I retired. How hard could it be to develop decarbonization? And I became a power plant developer. Wind and solar were pretty easy, and it was impossible to finance carbon capture. So I gave up. And so I started working with Carbon Capture Coalition to try to fix federal policies and teach at Stanford. I was going to retire, and Ernie Moniz convinced me not to retire and instead to run a thing called the Energy Futures Financing Forum. The mission of this beast is taken from a paper we did a few years ago at Stanford, is making green investing blue chip. Now, what does that mean? I mean, what it means is fundamentally, I do numbers, I used to design derivatives before they became illegal. We need to spend about $4 trillion a year in new CapEx on decarbonization. Great. Is that a lot of money or a little money? Turns out it's a lot of money. $2 trillion is the typical new investment flow into all the institutional money managers of the planet, okay? So just the new stuff we have to do to clean up our act is basically double all the new inflows into all of the pension funds and insurance companies and mutual funds and sovereign wealth funds. Okay, now let's go to CCS. Minimum financing requirements. Well, most of CCS is pollution control, right? So if I want to add CCS to a cement plant, that will purely drive up the price of cement. So if it's going to cost $80 a ton, I have to find a stable $80 a ton source of money. All right, well, geez, that's great. Well, the only one right now is a government incentive. And so I want to now talk about minimum financial requirements. Listen, Wall Street, I worked on Wall Street. Wall Street, if the CEO has a pulse and the business has a cash flow, it can be financed. And if it's good enough cash flow, it gets investment grade debt and it can go public and it can be a blue chip stock. But to do that, you have to have reliable long-term cash flow. CCS does not have that. So, what are the three things I think are key to fixing it? One is we had some talk here about, first of a kind and incentives. If you're going to start, let's just pick on cement, right? Because it's not a fossil fuel. If you got to fix cement, in order to encourage the first people, like Cemex or Heidelberg, to bother to put this installation into their plant, which probably is going to end up costing them $80 or $90 a ton for carbon capture, you have to have a clear vision of how you get from there to financeable under the current incentive schemes. We call this light at the end of the tunnel. You don't step into the tunnel until you can see the light at the end, right? So people don't do the first of a kind project unless they can see a trajectory to building enough of them to get their cost of capture down to or below current incentives, right? So what that means is you can't just do a first of a kind project and sit on your backside, right? In order to launch the first of a kind project, you have to have a clear policy supported trajectory to go first, second, third, fourth, fifth. And right now, carbon capture, right, pays $50 a ton, non-cash. Ignore that. Say sequestration's 15. So you have to get your capture cost down to $35 a ton. So something has to give, right? So either you have to have, policy support 400s, or you need to raise the level of the policy incentive so that within a reasonable number of new units you can get there. So, right, so light at the end of the tunnel. The second one is, and I'll quit, but three things only, because you can only remember three things. Light at the end of the tunnel, incentives that incentivize. Tax credits don't incentivize because basically no corporations pay taxes, and if they do, they have excess tax credits, and individuals can't use tax credits. So basically, nobody pays taxes, nobody can use tax credits, except for a very limited volume on Wall Street. You can't pay off debt, right, Khalid? You can't service debt with a tax credit. It's not cash. So direct pay is absolutely critical. And the third thing is, if you want to do a CCS project, you got three siting problems, right? Three of them. You got to site the capture, you got to site the pipeline, and you've got to site the sequestration. All of those things have different random timelines, And the hardest one is probably the geologic sequestration because of the time it takes to characterize a reservoir. So probably there's a very, very strong need to either through government-supported private pipeline and sequestration or straight up government-owned. And my mom was a communist, so I went, I worked on Wall Street. This sounds communistic, but I think you need government-owned pipelines and sequestration so that the poor bloody developer only has one job. Just figure out how to capture the carbon, and now I can deliver it. So those are my three things. Light at the end of the tunnel, incentives that incentivize, and cutting the problem down to one development issue, not three.
Thanks, Jeff. And I think you've stolen a little bit of the thunder from our next question.
What?
Yeah, sorry. So
Do that.
No worries. But let me reframe it a little bit so we can continue. And thanks everyone. That was a great overview. So our next topic was to talk about what are the barriers and challenges, more specifically, that's impacting the opportunity to more broadly fund CCS right now. And so some of the things we talked about were, as I mentioned, economic and policy barriers, which you brought up a few of those, Jeff, but also risk management concerns. And I'd love to hear how those are being addressed or can be addressed to encourage capital flow to CCS and how you guys are viewing the risk versus returns in the market right now. And we'll have a question later about looking ahead, but Jay?
Yeah, sure, happy to. I mean, I think I'll build on a lot of what Jeff was saying, but again, our perspective, we're focused primarily on direct air capture, but it's the same challenge, which is there's insufficient demand for CO2 right now, and not at, it's not anywhere near a high enough price in order to cover the cash flows that are required to make a project economic. And so there's a fair amount of market risk around, what is the policy incentive that's going to be in place that might actually be able to help, with covering some of that cost of CO2? Is there going to be a carbon removal market or voluntary carbon market that's available to help address some of the costs that, that basically cover some of the CO2 costs? And right now, I think we're at a very nascent stage in what that looks like for the development community. And so if we think about, direct air capture, we're talking about levelized costs of capture that are way higher even than CCS. The $400 a ton is probably what the most mature technology out there will be able to achieve. Vicki Holub was here earlier today talking about some of the work that they're doing around carbon engineering and DAC, and that's sort of on the mature end. But there's a whole bunch of other players that are north of $1,000 a ton in terms of levelized cost of capture, and we need to figure out how we can address some of the market risk that exists for these developers as they're looking to essentially enter into these offtake contracts with buyers who are interested in the carbon dioxide removal, and then be able to get to a place where they can finance projects through that, through those contracts. And that's a risk that I think, on our side at Breakthrough Energy Catalyst, we're looking to find ways that we can actually help, accelerate that process toward, accessing an offtake market for CO2 and either utilization or storage. And how we can support projects that may be super expensive today, but might have a trajectory toward becoming cost competitive and actually playing, a large role in the decarbonization journey over the 2030s, 2040s, and 2050s. And so I think, the insufficient demand, as I think you've heard in various different angles for CO2 is sort of a big risk and one that I think we need a whole bunch of stakeholders to tackle collectively. I think the other thing, this potentially is more on the direct air capture side than point source, but there's a need for supply of innovation as well, and a technological de-risking for a lot of the technologies that might be most effective long term. And there's a whole bunch of solutions that are sort of in the R&D phase, maybe moving to a pilot where they might capture and sequester 1,000 tons of CO2 per year as an example. But they have not been proven at a sort of pilot or even pre-commercial stage. And so we need to, use tools like RD&D that the Department of Energy is providing through the Fossil Energy and Carbon Management Office. We need to have more investment at sort of the sort of venture capital level that can be used for research and development for new startups that are looking to take these technologies into commercial applications. Breakthrough Energy Ventures has a portfolio of about 5 carbon capture companies that they've invested in. There's increasing investment flows going to these companies that are developing these technologies. But I think a second thing that's super important is that supply of innovation and how we can de-risk from a technology standpoint, so that in addition to the market risk, we're not also adding on technology risk that traditional investors may not be comfortable with or may not fully understand either.
Khalid or Michael, do you want to add any more?
Sure. Let me add a few more things. How we are looking at some of the barrier that you mentioned, but from our perspective, as I said earlier, that we have this fund available to cover fossil energy, petrochemical sector, and CCS is a very critical component to decarbonize the entire sector. One way you're looking at that, the way we are looking into different applications right now coming into us or loan request, there is one entity which has 3 buckets of business, which is the capture technology retrofit on an existing plant, and then you have the transportations, then you have the storage, and whether it's class 6 wells or EOR, whatever, these are the 3 different components of risk. And then some of them are putting all these 3 components of risk together, making one entity, and then coming to us. And then in other cases, we are seeing that, each of them coming separately, with their own business plan. One thing to keep in mind that the commodity or the output they have, there is no market incentive for them to get any premium. So these are either green power, green hydrogen, green methanol, or blue hydrogen, blue methanol. There is no incentive in the market that these are better quality product, and it requires a premium for that. That incentive still we are not seeing that in the market. As a result, we are pricing this commodity based on whatever the regular commodity is being priced. So that signal has to come from the market, number one. Number two, obviously, as Jeff said, that there has to have some more incentive from a tax benefit perspective that has to come up, 50, maybe too low, it has to go up.
Yeah, it needs to go to 85 or 90.
So there has to have some number has to go up, it's beyond my pay grade, what the number would be. So once that come together, then you're going to see an equilibrium, in terms of the price where we see that the project can move forward. Having said that, we don't see this thing as a barrier. Rather, we see these are process and evolutions in terms of get a project done. And there are a ton of interest. Some of people coming together on 3 business, they are bringing it together. There are more efficiencies we see from a cost-saving perspective, but then coming one entity, seeking only carbon capture. Also, from a technology perspective, if you having a post-combustion capture technology, which is amine saline, versus you have a ethanol, CO2 separations in ethanol plant, which is more of a fermentation process, the costs are going to be very different. So all these things, we have to put it together, and then we see that, well, maybe the ethanol plant will be cheaper in terms of the carbon capture perspective versus a post-combustion capture. So these are some of the things that we have to keep in mind as a lender and underwriter, which is the most cheapest way to fund some of this project. Thank you.
Yeah, I think I would just add again and kind of reiterate on the point. It's end to end what happens to the CO2 and where that fits into the overall businesses that are relying on that CCS. And we've seen many models, people looking to sequester, people looking to capture, people trying to form joint ventures around it. That's all achievable, but no matter how you break it down, the CCS and the business that's ultimately producing the CO2, it needs to be viable, and because that's what's effectively providing the revenue stream into everything. So when we talk about things like premiums maybe for providing a product that's a lower CO2 intensity, it's great if that comes, but for us as financiers and to get the lowest form of capital into these things, that needs to not just come, but it needs to be in some way have the ability to lock it in over the long term.
To be able to mortgage it.
Yeah, it can't be a fleeting, this year, everything's great, I'm having to play a premium, world's going well, next year I'm going to lowest cost of supply, because we can't fundamentally finance that in an efficient way.
Yeah, just building on this, I can sound like Mr. Doom and Gloom, and I'm not, but what we have to do is separate niche things from the huge volume we need to do, right? So we need to do like easily 1 billion tons a year of carbon capture in the US. Now, it's always good to take a positive first step, but let's talk about, niches, right? Because the niches can make you ignore the big picture. So it's easy to do ethanol, because it's already pure CO2. So I call that a niche capture business, right? And some people are going to pay voluntary credits. That's great, but not 20 years of voluntary credit at a locked-in price that I can mortgage, right? So you have niche financing, niche capture, and then, niche utilization cases. Well, okay, yeah, I can put it in beer. Great. First of all, you only rent it. Second, I calculated that one good-sized coal plant can carbonate, all the beer in the world. Oh, beer and Coca-Cola, by the way. So the point is that we got to celebrate the things that we can just gut out now, but we have to get policies that are durable and make sense for the long term. It's like poor Khalid, right? He can only do loans if you haven't taken a grant. Well, a brand new project that's first of a kind and scary probably needs a grant and a loan. And he wants to do the deal, right? Say the grant covers the equity, but you can't service his loan with a non-cash tax credit. So we have to kind of celebrate the people who have enough guts to do the first niche things. But we've got to be very clear, this is a pollution control service, and it's going to cost money, and not be apologetic about it.
Thanks, Jeff. So kind of moving forward a little bit, before we get to our look-ahead question, I wanted to just go back to the point about the technology and the proponents in the project. And Michael, one of the things we talked about was when we're looking at financing projects, how important is the role of the technology provider and the equipment manufacturers in making CCS financeable? I'd love to hear your thoughts on that and others.
Yeah, I mean, it's absolutely key. I tend to focus more on the capturer and the sequester, because those are typically the counterparties that we will face directly as a bank. But those back-to-back contracts with the EPIC companies and the technology companies are absolutely integral to the whole thing. We have to be honest about, as financiers, our ability to take on naked technology risk and where that, what we can do and what we can't. And I would just encourage, and the Institute's a great forum for this, but like as financiers, you maybe don't think about us as being brought along the journey of your technology development, but bring us along, because it's really helpful if when someone walks in the door with a project and they say, I'm going to use this technology, and I can say, oh, I've actually spoken to those guys, I understand that technology. And broadly, it's not just a new introduction and like, oh, here comes another technology play, because that's really, when we're busy, the easiest ones to dismiss are like, this has never been done before. Like that, it's unfortunate, but it just doesn't make it anywhere. So, keen to support new technology, but we need to be realistic about what we can do as debt financiers.
Hey, Michael. Oh, I'm just cackling over here because I give my students a thing to read, and it's called How to Lose a Banker in 10 Minutes. Right. And the first thing you're not supposed to say is, this is a brand new thing, and if you loan to it, it'll be great for you because nobody's ever done it before. And yeah.
Only better phrase, but similar theme.
Yeah. Well, so I encourage everybody to read that article.
Well, Khalid, can I just ask you to build on that? Because I know you mentioned how the LPO office reaches in and helps with the technology risk and that sort of thing. You've got your team of your back office that helps when you're putting the projects together. Can you just build on that briefly?
Thank you. In terms of our approach, we engage with prospective applicants or our client very early on. We try to understand their technology. And also, in some cases, our sister agency, FE, is also working on the similar technology. They have in-house knowledge, on how this technology coming along. So we learn a lot of things from them also. So this is one of the advantages that we have that no other private vendor have. So we have the engineers, scientists, and environmental people. We come together we try to understand that is this technology viable? Does it make sense, to take it to scaling up and then take it to the commercialization? There are a lot of projects that come to us. And sometimes it just doesn't make any sense, because the cost is too much expensive. There is no way that it is scalable, and the time that it needs, to lower the cost, the market has moved on, so it's not feasible. So once we have those understanding together, then we go through the underwriting process, as I explained, we do the loan, and we stay with the project, during the construction time, during the operation time, and then through all the way to the end, as long as the loan is on the book. We work with, during this process, things go wrong, during the construction time, even in the operation time, you have seen, what happened with the Vogel project, so we constantly stay with the project and the stakeholder all the time and bring everyone together if there is any kind of problem happen and try to resolve the problem immediately as soon as possible. That's something that we bring on the table compared to any other private lender.
Thank you. Jay, do you want to briefly add to that, or?
Yeah, sure. I think, maybe just to pick up the point around technology risk, I think part of what we're trying to do with Breakthrough Energy Catalyst is be willing to take on some of that technology risk that, maybe others aren't willing to. And I think, we're still looking for projects that have been demonstrated maybe in a pilot and are moving through that sort of first of a kind, either pre-commercial or commercial application, sometimes overlap with I think the projects that are applying to LPO and even moving earlier stage to apply for some of the grant funding that's available at the Department of Energy. But we ultimately need investors who are willing to, for those technologies that do have a path towards scalability and viability. I think we need either strategics who are willing to invest in some of these projects, maybe for a stake at the top co level in a company or warrants for future investment so that they can provide some upside in the future. I think there's other tools that we're thinking about leveraging. There's performance insurance, companies like New Energy Risk that are providing warranties for performance for some of these innovative technologies, which helps take some of the risk away as well. We're working with EPC firms, which Michael mentioned is another key lever, I think, in terms of how do we help these companies work with tier 1 EPCs so that they have quality front-end engineering and design studies as they're going to build their plant, and we're not going to have lots of cost overruns that come as a result of not properly building in sort of feasibility and development at the front end. And so I think there's a lot of tools that, there's a whole bunch of tools that need to come together in order to, take on technology risk and take on some of the sort of engineering and scaling risk that come as you're looking to build, first of a kind projects. And ultimately we have to, if these technologies are going to be, part of the solution. And we know we need, a whole bunch of them to be part of the solution.
Great, thank you. So for our last question, let's look into the future where the funding of CCS, with all the nuances that you guys have mentioned, has become more routine. What does that look like to you as panelists? And Mike, if I could start with you, just because you're funding in the later stage, I'd love to hear what you'd consider a routine CCS financing.
Yeah, candidly, when we look at CCS, it's $50 a ton. I mean, we think that a lot of the changes that have been made to 45Q, the structure itself is financeable, but that's the price. And so whatever the price is, a project needs to have a normal return at that price. And that's that's the hardest part of it. As we look at how the CCS market is right now, it really is a set of bilateral deals or integrated deals where the emitter and capture of carbon and the sequester are integrated contractually or whatever. But there is a possibility we get to a market disaggregation of these things, and you just put CO2 in a pipeline, and the lowest bidder for that CO2 picks it up, and away it goes. That's the dream, but we're a long way from getting anywhere near that. And I think there's a lot of temptation out there to kind of draw parallels with what's gone on in the solar and wind space. I struggle a little bit with that because solar and wind has benefited enormously from building hundreds and hundreds of thousands of exactly the same thing over and over and over again. And that feeds through not just into the manufacturing process, but it's a very efficient thing for a financier to look at because there's probably 3 or 4 reports they pick up. It's the same for every project. They look at it, and then, oh, I put it in my tax equity bucket. And if you look at how much tax equity came for those projects, it was huge, but a substantial part of it was from 2 providers. And it's very hard to see that happening in the CCS space because every project is going to be a little bit different, be it plant, be it geology, whatever. Something is going to be different, and we're not going to get that same repeatability. Doesn't mean we're not going to make a lot of progress in terms of reducing costs and executing these projects, but we're just not going to benefit the same way as solar and wind has. And so I think we need to, we need to be kind of realistic about the cost curve and like the, what is actually achievable in CCS.
I'm looking at it very differently. Some of us have been in the industry for decades, and I want to see the CO2 like a commodity similar to a natural gas market. And you have this Henry Hub, which is a pricing point that everyone understands globally. What does it mean? Similarly, if we have a pricing point for CO2, could be different hub in different region, in the States, So there is a buyers and sellers, going into those hubs, and they're buying CO2 from each other. And people who are buying, they could be using the CO2 for industrial purposes, for EOR, whatever the reason they wanted to have the CO2 for. And then the seller, through this pipeline they're going to build, is going to take it there, and that will be the physical delivery point. And then you go to the Bloomberg, you're going to see, if you put the button there, that what is the CO2 is trading at, how the futures look like, how the cash flow is going to look like for your project. That's what I want to see, how the future would be at some point, maybe 5 years, 10 years down the road.
Can I respond to that?
Yeah, absolutely. And Jay or Jeff, please.
Sorry, I just want to respond to that, and with great respect. And those of you who know me, this is the only time you'll ever hear me say I agree with ExxonMobil. But I agree with ExxonMobil on something, which is, at most, the US EOR market has, you can listen to ARI, maybe you can get rid of 300 million tons a year if you were super lucky, where someone pays you for it. But if you need to get to 1 billion, you have the next 700. Now, economics, right? If the first 300 has a price, but the next 700, you got to pay people to get rid of it, it all has a negative price. So I don't know how Henry Hub works for stuff where if you buy it, it costs you money.
Maybe the cement would be the one way to utilization. That's where you can start,
Yeah, we got to,
A lot of concrete we need to build highways and bridges,
Well, we can't see into the future, so who knows what innovation lies around the corner, right, Jay?
Yeah, I think, my 2 cents to add is I think, agree with Jeff that the ultimate, scale of carbon capture, most of that will need to go to sequestration and permanent sequestration. And there's definitely a utilization market that, hopefully will grow. But I think we need to make a lot of progress on building out the infrastructure that's available for that sequestration and enables the carbon capture, making progress on sort of those regulatory frameworks. But I hope, if I could, have a magic wand and sort of come up with a solution, I think it is, some durable policy instrument that can provide a stable, revenue source for CO2, and whether that's enhanced 45Q or something, some other instrument, the EU ETS or carbon tax. I think we need some instrument that provides certainty around that CO2, and I think you'll see CCS applications that get focused on certain sectors where it makes most cost-effective sense, whether that's cement and steel, or maybe less steel, but cement and other carbon-intensive businesses. And then I think you'll see direct air capture, hopefully, as well, which will be economic for a lot of the hard-to-abate sectors too.
Okay, Christine, 15 seconds.
Yeah, 15 seconds.
I was bad and dismissive because to Khalid, and I didn't mean to sound so. You could have a negative market, right? And I will sell to the person who charges me the least to get rid of this stuff, right? So that could work. But that depends on having a competitive sequestration market and a healthy network of pipelines. But it just won't be, nobody's going to be buying it. They're going to be getting bribed to get rid of it for me.
Well, this has been a great discussion. We're going to go to Q&A in just a moment, but I want to thank the panelists for all your perspectives and opinions. I feel much more informed about the path forward after hearing your thoughts. Let's go to Q&A now. And do we have any questions from the audience for these great panelists? Yes. Okay, one question coming in.
Okay. Casey Dealertel from ExxonMobil. This is maybe a little bit out of left field. I do government relations for our low carbon solutions company in Asia. So what we're seeing in Asia is a durable policy, but not immediate. It's more in the, countries are looking more at the 2030 timeframe. However, if you are going to meet the needs of that policy by 2030, you need to be thinking about CCS projects near term. How do you look at maybe pre-investment? So there's not a market now, the price isn't there yet, but if you want to do those projects by the 2028, 2030, you need to be ordering ships now. You need to be, working with governments now to get that moving forward. You need the financing starting to line up. How do you guys view this kind of pre-investment before you really know what the carbon price is going to be?
Anyone? Yeah.
In terms of the way we are looking at it, first is the sequestration. What are you going to do with the carbon? So that is the first question that we ask to our potential client or applicants. Obviously, you have a better financial incentive if you put the CO2 under Class 6 wells. That's a $15 difference versus EOR. And that's where we start our planning. And it takes about 18 months to get Class 6 permit on hand, unless if you have a primacy, as we talked about, Wyoming and North Dakota have a primacy right now. Louisiana probably will be the next one where it can move a little faster. So that's where the planning starts, and then from there you have the transport, how much it's going to take, who are the entity will be using the transport, and then the cost related to the capture, as Jeff was talking about, how expensive the cost is going to be. So that's how we put it together, whether the project is viable or not. And it starts about, a year to 2 years early, those planning.
Yeah, I would maybe I would say in response to this problem, I think that's like a major problem that a lot of technologies are facing, which is, there is not a policy that's sufficient in place now in order to, make project economics work. And at the same time, we need to deploy the technologies now, or else costs aren't going to come down at all. So I think, there's no silver bullet answer to your question. I think that is, a key challenge that project developers face. I think the way that it gets addressed is by piecing together a lot of tools and stacking them on top of each other to try to get these first projects built. There's a lot more government funding that's becoming available for the actual demonstrations, and so there was a whole bunch of money funded in the bipartisan infrastructure law in the U.S. In Europe, there's something called the EU Innovation Fund, which has tens of billions of dollars for these kind of early commercial projects. And I think you need to combine that with, money from strategic investors who have that long-term view of, what ultimately could be successful businesses in the long term, even if there's not, as much economic upside right now, investing at sort of the project level.
Hi. Very interesting, the discussion. I hear Francisco from Tekin Group. We produce a lot of steel. We are also we have an EPC company. We have an energy company. And one question after the discussion was, we all agree that you need to present a cash flow, a positive cash flow at the end of the day. And it might be challenged to assume that the cost of doing CCS will be less than the $50, because the $50 are only for 12 years. We need to do a cash flow for 30 years. So why not, and there are many companies that are thinking of, a carbon price, because that they are seeing that today the market will not pay a green premium, but in the near future, they will gonna pay a green premium. Or you might apply a carbon tax. For instance, the carbon border adjustment from Europe, it might apply to your company that you need to export products. So at the end of the day, you can incorporate to that project the carbon price of the meter. What do you think? Might it be feasible to finance a cash flow that has a carbon price that it might be traduced in a take or pay from that company. The emitter might say, okay, I will sign you a take or pay. At the end of the day, I compromise myself to pay you to dispose my CO2. So what do you think? It might be feasible to finance a project like that or not? From the Department of Energy and from the private sector.
Let me go first in terms of we have looked into that scenario. So what happened is that after 12 years, we still have some of the debt left, so there is a refinancing risk on the project that we don't know whether the market will be able to develop by that time, and there will be premium for the commodity, whatever the product they are producing out of that facility. So that's a challenge that we have to overcome, that taking the refinancing risk on the project.
Can I respond?
Yeah, sure.
So when we run the numbers on carbon capture right now in the U.S., we run them for 12 years because that's the end of the incentive. And if you're doing it like on a steel plant, say you're going to do carbon capture on the blast furnace gas furnaces, okay, after 12 years, it's a sheer cost, and you will terminate your capture project unless you have another source of cash flow. So, the incentive for these pure pollution control applications will need to cover cash O&M expenses, even if you can manage to get all your fixed capital investment covered in 12 years. That's a change that needs to happen to 45Q.
I'll add just one really quick thought.
Yeah, no, go ahead.
Yeah, as you referred to like the carbon markets and can we use like that, it's not there yet. Like we're actively following the carbon markets and we're trying to see like how can we effectively use that like a futures market for when 45Q et cetera goes away. It's not there yet. Like the reality is we're terminating at 12 years because it's like that market is not sufficiently mature, certainly out 12 years, but even out 2 years to enable us to lock in any kind of premium. And then we come back to the, okay, maybe there's some kind of leveling tax or whatever, but where ultimately does your product and your company sit in the whole kind of cost curve of that industry becomes important. And it may be that carbon capture isn't actually a huge cost in your business and therefore you can continue to run it. But if you're like a higher quartile producer and your margins start getting squeezed, the first thing you're going to do is shut off carbon capture and storage if that's a net cost to you, because it's the economically rational thing to do. So if you're lower quartile and you say like I can keep running this until the market gets completely flooded with steel, then that's a really interesting project to finance. But that's not generally the projects we're seeing right now.
I think we have time for one more question before lunch, which I know everyone is interested in.
Definitely I'll try to keep this short so I don't get beat up on the way to lunch. But we keep coming back to the magic number for 45Q. If it's above this number, industries come in. If it's below this number, industries are out. I get that, I understand it, but perhaps we're thinking about this, dare I say, a little incorrectly. Would there be an appetite for something that had much in the similarities to the RFS, or really the renewable volume obligations under the RFS, that looked at the market and assessed, hey, we were supposed to have 1 billion tons this year. We didn't. As a result, 45Q is increasing. We're pushing parties to adopt this. And if that were to be, well, the question is two. One, would there be a policy that we can envision, we're not going to come up with it now, we can envision that would call for increases in amounts of CO2 to be sequestered? And if that were to be implemented, would it be, most importantly, bankable? Trying to bring some sticks into this other than just carrots and hoping that at some point we go, all right, it's crossed this threshold, now everyone can start, when we know we don't have time to wait.
It sounded like a carrot, not a stick, right? If you're, right, but I mean, that's what the, British CFD, contract for differences on offshore wind, they just said, we need this much offshore wind, and we're going to offer people a fixed price contract for the output, effectively a hedge, for the best 4 that show up. I'm
trying to get to an implicit cost of avoiding ton of CO2.
Yeah, but probably you can get it to $85 cash money for GS. You will catch most of the nth of a kind projects, right, but you're going to need extra policy support for the first 5 or 8.
Right, to your point about the term, right?
Right.
12 years is great, but we need projects.
Yeah, and you need $25 or $30 hanging on after 12 years, or everybody will just shut off.
Well, I think at that point, we are going to wrap up for lunch. So thank you very much, panelists. I really appreciate your time and your expertise.